Most traders lose money because they follow the crowd. But what if I told you there's a method the banks use to trap retail traders and it's called smart money concepts? Today, I will show you how to trade like the institutions, even if you're a complete beginner. Welcome back to my YouTube channel, guys. I'm OLUWA-POUNDS and I drop Forex updates which will make you profitable. SMC stands for Smart Money Concept. Now, basically, Smart Money Concept is just like a method which studies how the bigger institutions trade. Example, the CBN or the bigger institutions like banks and so many other things. Example, like in World Banks, you understand? So, Smart Money Concept, they studied the way they move, the way they trade, you understand? So this concept is all about the smart market movers, you understand? So now, this smart money, they also focus on liquidity, market structure, and manipulation. You can see in my screen now, this is what we call liquidity, whereby there's a liquidity sweep before price going to its direction. Now this is the market structure, whereby price has been breaking structure to the upside before changing character. Now this is what we call manipulation. Now you can see this is a clean setup after price sweeping and liquidity. Price was supposed to tap us in at this particular area before going up, but price did what? Take us out and start pushing up. This is what we call manipulation. These three steps are what we look out for if you are trading SMC, because the smart money traders, they normally move with liquidity or move under market structure, or they can also move with manipulation by taking out us, which are the retail traders, taking us out before they are moving to that particular point of interest. Now we'll be looking at the three basic concepts, or let me say four. They are up to four basic concepts of SMC. Now, first of all is the market structure. Now, when we are talking about market structure, we're talking about price, like I can see here as an example, whereby price will be breaking structure to the upside, because price can't just move in a straight line. Price need to be breaking structure to the upside. So this is called a market structure. A break of structure to the upside before creating a double top, then a change of character and a continuation to the downside. You understand? So this break of structure is just a continuation of trend, showing a continuation of trend that yes, price is keep pushing up to the upside. Once there's a change of trend, price is going to produce what we call a change of character, then it's about to be going down. Now, example. This is an example. If we are going to the upside, price will be breaking structure to the upside. Instead of going in one straight line, we need to be breaking structure to the upside. But now, when it's time for price to change and reverse to the downside, price will cause what we call a double top or a liquidity sweep, and did what, and create a change of character, showing that this uptrend is no longer valid. Now we are going to the downside, and then price will start doing what? Creating a break of structure to the downside. This is how markets move. Markets move either up, down, or sideways. When I mean sideways, I mean like this, consolidating. Market will just be consolidating. No exact movement, just consolidating. You understand that, guys? So the other one is what we have, is what we call liquidity. Now liquidity is, let me say for example, liquidity just can be seen as stop loss. You understand? Retail trader stop loss. You understand? And these are the most particular place whereby the smart money traders target your stop loss. They can target your stop loss. They can't see your stop loss, but they know where retail traders are likely to set their stop loss. For example, this is a range, this is a market range, and this is another market range, and this is the market movement. Now, as a retail trader, once you see something like this, boom, you'll be like, yes, this is a breakout. And after seeing a breakout, you see something like this, a retest to that breakout and a continuation to the upside. Then retail traders, they do what? They do set their stop loss. They do set their stop loss below here. If they should enter from here, their stop loss will be below this particular place. That's where their stop loss will be, and their take profit should be at least 1:3, or some greedy ones might put 1:5. So let's leave it to 1:3. Then, you know what the smart money do in a scenario like this? You know what the smart money do? They push price back down again and take you out before the main movement do what? Will start continue. That is what they do to make their money in the forex market. So now the second one you have is order block. Now smart money, they make a move with order block. Now what is an order block? Order block is the last candlestick before a bigger candlestick moves. You understand? Now for example, let me show you an example of order block. Let me clean this. Where there's order block, there's a smart money. Where there's liquidity, there's smart money there. And where there's a market structure, there's smart money there. Now, for example, we have this small candlestick here. This is a small candlestick. This is another candlestick. This is another small candlestick. And all of a sudden, we have this big candlestick like this. Boom. And again, following it by another big candlestick like this. Boom. Now, this is what we call our order block. This is our order block here. This candlestick here is our order block. And this big move are caused by the smart money. So this candlestick represents the last candlestick before the smart money entered the market. Now, if you see any big spike like this, just understand, yes, know that yes, that the smart money traders are in the market. They are making move in the market. That's why you can be able to see a bigger push like this. Now, what we'll be talking about again is imbalance. Imbalance can be seen as liquidity, as fair value gap. Understand? Now, fair value gap might be price. For example, now this is a big movement in the market. We are going up. We are going up. You can see this is a bullish form. This is a bullish form. We are going up. We are going up. But all of a sudden, price jumped and keep on moving up. You understand? Now, from here to here is what we call a fair value gap. This is our fair value gap. You can see from here, there's no fair value gap over here, but from this particular place, there's a fair value gap over here. So what we need price to do is to come down like this, close this fair value gap, tap in inside that fair value gap, and do what? And continue pushing to the upside. This is what we expect price to do. Now, in this particular scenario, this also shows that smart money creates what we call fair value gap in their movement, because for a big movement like this to happen, there must be a fair value gap. You understand? So these are the 5 basic concepts of smart money concept. So now I'll be showing you guys a real chart example, but before that, let's mark out our illustration. Now this will be what we'll be looking at for the market. First of all, I'm going to look out for the market structure or the overall trend of the market. If the market is going bullish or the market is going bearish, something like this, we're going to see something like this, and this is going to give us a momentum that yes, we are bullish. You can see we are bullish because price has been breaking structure to the upside. A break of structure to the upside. You can see another break of structure to the upside. This is it, guys. So now we expect here to be our order block, because this is the last candlestick consolidation before this big move happen. So this is our order block here, last candlestick before this big move happen. And after seeing our order block, what we need from price to do is just to give us something, create something like a liquidity. Then we'll be like, yes, this is our liquidity, and price need to sweep, because if there's no liquidity, you will be the liquidity before we buy. So this is what we need from the market. Now let's dive into the market to look for a live example. Now this is our live example from the market. This is GPJPY, and you can see this is a break of structure to the upside. Understand? And after seeing this break of structure to the upside, we need to mark out our order block. Now in this particular scenario, you can see we have 2 types of order block over here. This is our order block. This is a little order block over here. And this is another tiny order block over here. Now in this particular scenario, if you see this particular thing in your chart, what you need to do is just pick up your Fibonacci tool, and you measure from down to the upside. Now you can see this is the 50%, the premium and the discount But if wait, not here, yeah. Now, and as you can see from this particular place, price has already mitigated this fair value gap over here, and this other block is invalid. This other block is invalid. We need something like a confluence before you can be able to trade this particular other block, because price have already mitigated its fair value gap. Now, and you can also see this pullback. This pullback is massive. If you are live, if you are watching this particular trade live, and you are seeing this massive pullback, you better stay out of the market, because what you don't need a pullback. What you just need is just a little retracement. Now you can see something like this now. And let me show you. Let me give you an example before we go back to this one. Let me give you an example. Now look at it. Look at here now. This is a change of character to the downside. After this break of structure is a change of character, because now we are changing character to the downside. And after seeing this change of character, what else? You can see our other block here, because this is the last consolidation candlestick. This is our other block over here. And after seeing that other block, you can also see our fair value gap inside here. You can see that, guys. This is our fair value gap, and this is our other block. Seeing these two together, now compare this pullback. Can you compare it to this particular pullback here? You can't compare the two of them. Because this is aggressively. Market is moving. This is so volatile. Market is moving fast in this particular scenario. But here, market is just going small. So this particular entry is valid than this particular entry. So just need to set your stop loss will be above the latest high. Yeah, which is there, and our TP should be below here, which is 1:2.7, and you can see TP smashed, as easy as that. Let's look for a sell scenario. Alright guys, this is yen basket, and this is another scenario of this particular time is about a bullish movement. Now this is a break of structure to the upside, because as you can see, we have been breaking structure to the upside. So this is our break of structure to the upside, and this is our other block, and this is our LVG. Our MVG in between here. This is our LVG here. And after seeing something like this, you don't need anybody to tell you what next to do. This is our liquidity. This to here will serve as our liquidity. So you just stack in your from your other block here. Our stop loss should be below this man here. Yeah. Yeah, below there, that's where our stop loss should be. And after that, you emerge to at least 1:3. Above here to avoid doing mistake. Above here, that is it, and chicken smash to TP, as easy as that. Now, in the aspect of risk management and mindset, here are 3 things I need to tell you guys for you to have it in the back of your mind if you are going to trade with this particular concept. Now, first of all, patience is key, because without patience, you can't be profitable in the market. You need to be able to wait for price to come to you. Don't chase after the price. Don't pursue the price. Wait for price to come to you. Then you can be able to stack in your positions. You understand? After setting out your point of interest and you're marking out your other block in which you'll be taking your position from, you wait for price to trigger you in. Don't just trigger yourself in, or just open market order execution sharp because price is, let me say, 3 pips close to your order block. Don't do something like that. You wait for it to tag you in before pushing up. You understand that, guys? And again, you only trade what you understand. Do not trade what you think. Don't think that price will move, because you are not the father of the market. You do not have control of the market. You're just trading the differences of market price. That's what you're just trading. You're a CFD trader. So all you need to do is just you enter any trade that you fully understand the potentials of that particular setup. You understand? If you see any setup, make sure that all your 4 or 5 elements which make up one particular setup for you are seen in that particular setup before you can be able to stack in whether your buy or your sell position. You understand that, guys? And again, always use your stop loss based on the structure. If you want to set your stop loss, do not say let me set 10 pips stop loss or 20 pips stop loss. If you do something like that, price or the smart money trader can manipulate it and tag you out before markets go into your expected area. So all you need to do is set your stop loss in a structure form. Maybe the last low before you enter the market, that will be where your stop loss will be. Because if once price should hit your stop loss, then you are definitely changing in the trend direction. You understand that, guys? So now, don't just copy signals, okay? Learn the concepts. If any mentor teaching you about trading, learn his concept or his or her concept very well for you to be able to be smart in this Forex journey. I wish you success and good luck. If you found this video helpful, please kindly subscribe, comment SMC if you want me to do a live breakdown in our next video. See you guys next time.